Hi everyone, good evening, and a warm welcome to our LLF Let's Learn Futures webinar series. We are delighted to have you here with us today. And before we get started, please confirm that you can hear my voice clearly by typing yes or share an emoticon in the chat box below. So if you are able to listen or hear me clearly, please type in yes in the chat box below so that I know everything is well on your side. Great, thank you very much, everyone. Now, our topic for today is fundamentals you must know about gold and currency futures. This LLF webinar series is proudly brought to you by Bursa Malaysia in collaboration with our company Excellent. I'm CY Saw. I will be the moderator for today's webinar session. We are privileged to have Chin Yi Xuan with us today to share with us this informative session about what are the fundamental things you need to look at when you trade gold futures and currency futures. As you know that besides technical analysis, besides looking at charts, price, volume, and technical indicators, fundamental analysis also plays an important role in determining the forces of the market in trading. Therefore, our topic for today will be sharing with you the fundamentals you must know about gold and currency futures, where Yi Xuan will elaborate on this topic in greater details. I noticed there are more people here just enter this webinar room. Before we begin, just a quick final sound check. Please type in OK or yes in the chat box or give us a thumbs up to confirm that you can hear me clearly. Very good. If you need, you can adjust your volume settings to ensure optimal sound quality. To ensure you can enjoy the smoothest and highest quality video experience on your side, I highly suggest that you turn off your video camera during the session, as this will help ensure that everyone can enjoy uninterrupted webinar session and have an optimal learning experience. Our session for today will be divided into two parts. The first part will be presented by Yi Xuan. Following that, we will be opening up for a Q&A session where you can ask any questions related to today's webinar topic. To ensure we can address your questions, you can follow these two steps. You can submit your questions in the Q&A section below and send them to all co-hosts, as this will allow me to directly capture your questions easily. And please note that due to the volume of messages in the chat box, it may be challenging for me to spot your questions if you don't submit your question in the Q&A box. And along the way, if you have any question, you can type your question in the Q&A box, okay? As this LLF Let's Learn Futures webinar series is brought to you by Bursa Malaysia, we have upcoming exciting topics and more to come. So each and every Tuesday, we will be having this LLF webinar series. We have topics that will be conducted in three languages, English, Malay, and Mandarin, where our panel of speakers will be sharing with you insightful knowledge and practical strategies related to futures trading. There will be more content pack and informative topics lining up, and we will be adding to our list accordingly. So if you're interested in any topic and want to improve your knowledge and skills on futures trading, you can scan this QR code, register yourself, and make sure to add it to your calendar so you don't miss any of the sessions. Besides the LLF webinar series, we also have the LLF online workshop. Now, this online workshop is different from the webinar because this online workshop is specially designed for those of you who are new in getting started in futures trading. In these workshops, we will be covering a full set of beginner's knowledge in futures trading. It's a step-by-step guide to enable you to kickstart your first futures contract. Each session is 3 hours. So if you're new to futures trading and would like to learn about futures trading, quickly register yourself in these online workshops. It's entirely free and fully sponsored by Bursa Malaysia. It's also limited to the first 50 online attendees, so you need to grab your seat fast. Before we begin, it's my pleasure to introduce our speaker for today, Chin Yi Xuan. With a background in economics from University of Malaya, currently Yi Xuan is the General Manager of Algopedia Sdn Bhd, which is a proprietary trading firm in Malaysia specializing in algorithmic trading. He has over 5 years of content creation experience on personal finance, investment through his personal blog, nomoneylie.com. Besides that, Yixuan is also featured in various media platforms such as City Plus FM, BFM Caijing, and others. Without further ado, I'm delighted to hand over the presentation to Yixuan. Yixuan, there you go.
And today our topic is what you need to know about currency and gold futures. So if you are new or you wanted to learn a little bit about how currency and gold futures work in Malaysia, this is the webinar you need to attend. Now a quick disclaimer, this presentation is provided for general information only, is not intended as an advice or offer or solicitation for purchase or sale of any securities, stocks, futures, or investment products. Stocks, securities, and futures imply risk and to be undertaken only if you understand the risk. Please seek your own tax, legal, and financial advice before investing in stocks and futures. All information in this presentation is subject to change without notice. Now, what are we going to talk about today? Today, we are going to talk about what you need to know about the fundamentals of the Chinese currency and some of the interesting and historical facts about Chinese currency. Other than that, we are also going to explore what's the relationship between the Malaysian ringgit and the Chinese currency. And we are also going to explore the fundamentals of gold. And finally, I'm going to share with you some of my personal ideas or approach on how to trade the Chinese currency futures and also the gold futures in 2024. Now, before that, do you know that you can now trade the mini US dollar and offshore Chinese currency, which is FCNH and gold FGLD futures through Bursa Malaysia derivatives? Now, this is very, very exciting. This is a very new product from Bursa Malaysia, which is the mini US dollar / offshore Chinese currency futures, which is FCNH. So after this sharing session, if you guys are interested to gain exposure to the Chinese currency, this is certainly one of the best way to go, because through the futures market, you can is highly regulated and you can perform your trading, be it to the upside or downside. In short, you can go long or short for in this through FCNH. Now, aside from that, you can also trade gold futures in Malaysia through FGLD. So this is also a fairly new product that was released last year, where you can gain exposure of gold because it tracks the international gold price and is regulated by Securities Commission and is denominated in US dollar and settled in Malaysia ringgit. Now, why trade FGLD? A quick one, because you can trade gold in both directions, be it long or short, and you can hedge against the downside risk in the physical market, especially if you own gold as an investor. And also, you through the futures market, you get access to leverage, which means you need a lower capital requirement to trade gold, which is a fantastic thing. Now, with that in mind, let's start. Let's go straight ahead into what our main discussion today. Now, to understand one of the key currency, the currency that we are going to talk about today is the Chinese currency. And to understand Chinese currency, I think it's very important for me to lay the context. So allow me to share with you 4 very interesting and important facts about the Chinese currency that you need to know. Now, by the way, do you know that the Chinese currency exists in 2 forms? Number one is the offshore Chinese yuan, which in short we call it CNH. CNH is basically used outside of mainland China, such as Hong Kong and the global financial market. And why? Because it is freely convertible, which means that it can be used for international trade and financial activities. Now, another one might be a little bit more familiar for most people, which is a Chinese yuan. It is basically, or in short, CNY. It's basically used for transaction within mainland China. Now, when it comes to price movement, generally speaking, CNH and CNY tend to move in tandem with each other, as you can see in the chart on your right. So basically, they move together, in short. So in general movement, they tend to be the same. So this is one of the many interesting facts that most people may not know. Now, Another very interesting fact is, unlike the US dollar, right, which the value is determined by the market forces, the Chinese currency is actually what we call a managed float currency. Now, what do I mean by that? Managed float currency, right, essentially means that the extent of how the Chinese currency move is partially managed by the Chinese authority. Now, and how do they do that? If you may ask, right? This is done through a mechanism called a yuan midpoint fixing, where the midpoint every day the Chinese authority will get a reference from multiple some of their financial institutions, and they set a midpoint to decide how much is the Chinese currency against the US dollar. So as such, right, after you set the midpoint, the dollar renminbi is allowed to trade 2% on either side, to the upside or to the downside from the midpoint every day. So this, because the Chinese currency is a managed float currency, this allows, right, the Chinese central bank to step in whenever they think that the Chinese currency is too strong or too weak. So as you can see in the screenshot, last year, in August last year, 2023, when the Chinese currency was weakening too much against the US dollar, the China central bank actually step up with to intervene against this weakening situation. So how does it work in exact? Let me show you a quick graph over here. This is what happened. So this graph, right, basically shows you the difference between the midpoint set by the Chinese authority versus the expectation or forecast by the financial institutions, right? So as you can see, it has been very, very stable until, if you can see on the very far right, is during the August of 2023, where the Chinese authority actually set the midpoint, which is very different from the expectation of the market. So you can see from this chart where the Chinese authority can actually step in to intervene or make adjustment whenever they feel like things starting to not to go out of control, be it the currency strengthening too much or weakening too much. So this is some of the very interesting fact as well. So interesting fact number 3 is, do you know that in 2015, the Chinese currency actually underwent like one big devaluation exercise? Yeah. So in 2015, the Chinese authority actually decided to devalue their currency after a decade of economic growth in the 2000s. Why? Because they feel like after a decade of economic growth, right, the currency has grown strong. So they feel like an appreciation in the Chinese currency will reduce the competitiveness of China's export, which could potentially lead to lower growth and problems like increasing unemployment. So what you need to know, essentially, ladies and gentlemen, is this devaluation exercise, the impact is very big. For one, because things become cheaper after devaluation in China, there's an increased competitiveness of Chinese goods among when you compare it to global products. And as such, right, this will lead to strengthening in the China's manufacturing sector. And relative to the Chinese currency, because China devalued their currency, in relative, US dollar became stronger. So what happened is it increased the purchasing power of the US consumers towards Chinese goods. So it led to an increase in import spending from the US. Now, it also means that because US product became more expensive to the Chinese people, right, there will be a drop in US exports. Now, this is quite interesting because it leads to another very important incident in, I would say, a milestone in the Chinese currency. In 2016, the Chinese currency was given the status of reserve currency by the International Monetary Fund, which is the IMF. Now, because of the devaluation exercise, because it was intended by China to make their currency more market-orientated, to be included into IMF special drawing rights, which is SDR, basket of reserve currency, alongside major currencies like the US dollar, the euro, the yen, and the pound. Now, what is an SDR? If you may ask, some of you might ask, right? SDR is essentially an international reserve asset, right? That allows IMF members to purchase domestic currency in foreign exchange market to maintain their exchange rate. So IMF re-evaluate their currency composition every 5 years. But what you need to know, actually, the most important thing is the impact of China currency given the reserve currency status. Number one is the China currency is recognized by the as a stable store of wealth by the financial world. And number two, since the rate of borrowing from IMF depends on the interest rate of the SDR, which is the basket of currencies, the cost of borrowing would be influenced partly on China's interest rates. Now, understanding the history, now that we understand the history of the Chinese currency, right? We come to another very important discussion. Is there a correlation between Malaysia ringgit and the Chinese currency? Now, let's take a moment and take a guess, right, of ladies and gentlemen who's listening today. Okay, number one, do you think that the Malaysia ringgit and the Chinese currency is positively correlated, meaning when the Chinese currency go up, Malaysia ringgit go up? Or number two, do you think that the Malaysia currency, our Malaysia ringgit and the Chinese currency is negatively correlated, meaning when the Chinese currency goes down, Malaysia ringgit goes down? Which one do you think? One or two? Comment leave your comment in the comment section, right? Let me know what you think. Okay, I think some of you mentioned positively correlated. Thank you. So the answer is it depends on when you look at the situation. So remember that I mentioned the Chinese currency was actually given the status of reserve currency in 2016. So what you are seeing is, on this chart, what you are seeing is basically the blue line represents the US dollar and Malaysia ringgit. The red line represents US dollar and the Chinese currency. So essentially what it tells you from comparing this chart visually, right, is you can look at the correlation on a visual perspective. Now I want to divert your attention. Oh yeah, before that, how do we measure correlation? So if you look at this chart over here, you see like a small letter R. This is the sign of correlation. So if the correlation is nearer to 1, the higher it is to 1, the closer it is to 1, means the stronger the positive correlation between two elements. If it's closer to -1, this means that there are stronger negative correlation between two elements. Okay, now what you're seeing right here, I want to divert your attention to before 2016. Now, before 2016, on your left, right, if you look at the chart, before 2016, the Chinese currency, when relative to Malaysia ringgit, was actually in a mild negative correlation. This means, right, they have very little relationship or very weak negative correlation. But after, if you look at the first circle on the left, after 2016, when the China is recognized as a reserve currency, if you scan through each chart by the timeline as it goes, right, you will start to notice that our Malaysia ringgit's correlation with the Chinese currency becomes stronger with time. So you can see the R value becomes stronger with time, 0.79, 0.81, 0.93. So as such, right, Malaysia ringgit and yuan, or the Chinese currency, has been gaining positive correlation since the Chinese currency gained the status as reserve currency. Now, how about recently, right, 2022, 2023? Now, what happened in 2023? I will share more about it, about the situation, fundamentals of China economy later. But essentially, China economy has been facing some challenges, right? Instead of raising interest rate, they have been cutting interest rate in 2023. So what happened, right, when they cut interest rate? Their currency become weaker against the likes of the US dollar. So as such, you can see our correlation, right, in 2022, which is marked in orange and gray, and 2023, which is marked in gray, we are actually very, very high, very, very close to 1, right? Which means one of the reasons why our Malaysia ringgit weakened so much against the likes of Sing dollar or also the US dollar is because we are positively correlated with the Chinese currency, which drag our Malaysia ringgit's performance. Now you know, right? Now that we understand the history and the interesting relationship between Malaysia ringgit and the Chinese currency, let's look at some of the very important fundamentals behind Chinese currency, especially for 2023. Now, the Chinese currency has weakened against US dollar in 2023. If you look at the chart, this is a US dollar Chinese currency chart. US dollar has been in the uptrend against the Chinese currency. What happened in 2023? Now let's look at this. Number one, this is because there have been a very different policy or in terms of interest rate decision between China and the US in 2023. You can see in the black line, US has been raising interest rate while China has been cutting interest rate. So as I'll talk about this more in coming slides, China has been facing a difficulty in their economy especially last year. So to spur growth in the market, they actually cut interest rates so that it provides more liquidity to the market in hope that it will spur economic growth. So when this happens, right, when the interest rate difference is so big between US and China, capital, can you take a guess? If you have money, where would you want to place your money? Obviously, for most people, for most investors at least, they'll be placing money in the US dollar, which gives them a higher interest rate, right? Makes sense? Now, this is one of the reasons why there's such an interesting scene in the global market. Now, number two, China has also in 2023, actually way before 2023, their property or real estate sector has been struggling, as you can see in the screenshot over here, right? Not too long ago, China, one of the largest property developer, Evergrande, has been ordered to be liquidated, right? By the institution, right? By the market. So as such, this is a very challenging sector, and because real estate sector has been a very important industry to the China economy, China economy took a hit. Now let's look at some numbers, right? Now in 2023, the new home sales for the China market actually dropped by 6%, and on the other hand, right, second home prices has been declining as well. So, and not only that, right, if you follow the news, you would know that the property developers in China, they have been defaulting, right? Since 2020 to 2023, they have been in bond default of almost close to US dollar 125 billion. So all of these factors combined actually drag the whole China economy down as well. Now, it's not just a property sector, ladies and gentlemen. The China economy has been in a very challenging state as well, especially when it comes to their export. So if you look at this chart over here, in 2023, their export has dropped for the first time in 7 years. So the last time they have a declining year in export was in 2016. If you look at the red color highlight on the left, right? So this is how challenging the economy has been for China. And not only export, right? Consumption as a whole has also been challenging for China. So retail sales, you are looking at this retail sales data in China. In 2023, retail sales rose by 7.2%. While this seems like a good thing, right? It is positive, right? But the growth is the weakest if you exclude the COVID years. Yes, it's the weakest since 1999. So as a whole, you can say that the China economy has been in a very challenging state in 2023. And all of this thing combined, ladies and gentlemen, this caused a deflationary risk in the China economy. Now, some of us Malaysians, we are very familiar with inflation. Things become more expensive. But in China, it's actually a very interesting scene where typically Malaysians, when they see price dropping, they say, yes, good, the price finally dropped, right? Life would be easier. But in China, has been they have a very unique market economy condition right now. So imagine China has a weaker currency relative to the currencies like the US dollar. So with weaker currency, you imagine, right, there'll be, because China with a weaker currency, things become cheaper in China for other countries like the US, right? You would imagine that export would increase. And when export increase, company makes more money. By right, companies will pay more to employees, which means when employees make more money, right, people like us, we will spend more. And when people spend more, we will have a healthy inflation. But situation is slightly different in China because they have a lower export and consumption throughout the country. What happened is they go into a price deflation. Price falls due to weak demand, and because demand stays weak, right? People tend to not delay their spending because they're expecting price to get even cheaper. So imagine if today the price of property is dropping, but if you expect it to drop further, will you buy it today? No. So because you're expecting it to drop further, you want to get a better deal. So you defer your spending. So this is what's happening in the China economy right now. It goes into a very challenging, I would say, a death loop in the market because of this deflationary risk. Now that we understand what happened in the China economy right now, I would like to share with you some of the things that you need to consider while trading the US dollar and the Chinese currency or FCNH futures in 2024. And again, this is my own opinion, right? So there are two things that you need to be very aware of if you are a trader or investor in this market. Number one is how would the Chinese government manage their deflationary risk this year? And number two, another very important thing to note is how would US decide on their interest rate decisions in 2024? These are two key things that you need to pay attention to this year. Now, to give you a quick context, the Chinese currency has been weakening against the US dollar in 2023, and also they're also facing deflationary risk, means prices are dropping due to a weak economy fundamentals such as their export, consumption, and their property sector. Now, as such, right, you need to observe, right, this year, can a weak Chinese currency raise domestic price of imported goods to spur inflation enough to help unroot China's deflationary condition? Now, which means, right, can the high, because as a whole, China have a weakening currency, so relative to that, the US products that they import become more expensive, right? So we hope, we shall hope that this more expensive imported goods can spur some form of inflation back to China to help counter the deflationary effect. So there are a few things to consider. Number one is in order to do that, theoretically, it's very easy to engineer a weaker Chinese currency, which is simply to cut rates further, right? But what if the US begin to cut rates, their rates as well this year? This will the difference, if the US started to cut rates this year, the US and the China interest rate differential will start to shrink. This will leave the Chinese currency with the chances that it will grow stronger instead of weakening. So this is something to that the China government can do. However, the case against this, right, is if China decides to further weaken their currency, China's trading partner, people like countries like Malaysia, will be less likely to, less willing to accept Chinese currency as payment if they think that the currency will keep losing value. Also, if the currency keeps dropping, right, there will be increase in capital outflow to other places or countries that offer better interest, like the US. Now, this is something that you need to pay attention to when you wanted to trade or invest in the FCNH. Now that we covered the factors or fundamentals about the Chinese currency, let's cover another side of the story, which is gold, right? In this section, I'll share with you the fundamentals and ideas to consider while you are trading gold. Now, Now, first of all, I have two questions for you. Number one, who do you think gold is a volatile or stable asset? If you think it's a volatile asset, you can just type V in the comment section. If you think it's a stable asset, type S in the chat. Right. So some of you type V, some of you type S. So we'll find out through statistics, right, through data, and see if gold is indeed a stable asset, as most people tend to assume, right? So, okay, I'll just tell you the answer first, all right? So gold is fundamentally volatile in nature, especially when you compare to, assets like bonds and home prices. So I want to divert everyone's attention to this very interesting chart over here. This chart comprises of the real asset class returns from 1972 to 2021. There are 6 assets here: gold, S&P 500, which represents the US stock market, international stocks, US real estate investment trust, the US Treasury bond, and the US home prices. So basically what you want to know here is if the chart of a particular asset swing up and down a lot, right? There are bigger swing to the upside and the downside, means that it is a relatively volatile asset. So if you look at gold relative to US Treasury bond, which is in blue color, and also US home price, which is in brown color, you'll notice that gold is actually more volatile asset compared to the other two. And not only that, if you look at the gold, right, if you look at this visual compared to the likes of S&P 500 or the international stocks, you'll notice, ladies and gentlemen, that gold actually is not so much of difference, right, in between, at least in terms of the swing that they experience, right? So what we can say from this, from historical data, is gold is actually a fundamentally volatile in nature asset. So if in the future, whenever if your friends who are investor, or some of your parents, right, who might have some form of assumption tells you that gold is actually very stable, buy gold and so on, you should this chart today, based on historical data, shows you that it's actually not as, I would say, not as stable as most people tend to think. All right. Now, I have a second question for everyone. Now that we understand from historical data that gold is volatile. Question number 2. Do you think gold is an effective protection against inflation? All right. Question number 2. Yes or no? Right. Let me know in the comment section. So the question is, do you think gold is a do you think gold is a good protection against inflation? Yes or no? All right, I'm seeing a lot of yes. Okay, now let me review based on historical data again. Let me review the answer to you guys. So gold is actually not an ideal inflation hedge. So let me show you, right? This is the years where US inflation is more than 4%, which is what we consider high inflation, right? So all these years was when US experienced inflation more than 4%. This is the performance during all those years, right? I kept it to +2 and -20%, so it's easier for you guys to visualize. So as you can see, right, gold performance, when it actually swing both ways in high inflation environment. So what this suggests is gold's positive relationship over inflation is not as strong as what most people tend to assume, right? In other words, gold is not the most ideal inflation protection against inflation based on historical data. Now, if these are not the most important thing, right? What is, right? What would you want to use gold for? Yes, the gold is actually, there's one very important benefit of having exposure to gold in your portfolio, which is to use gold as a portfolio diversifier. Now, over a 30-year period, right, from 1993 to 2022, gold actually had exhibited a low correlation to major stock market. So what do I mean? Remember, what do I mean by this? Remember when we measure correlation just now in previous chart when we discussed about Chinese currency, we use a measure of R. If R is closer to 1, means that they are positively correlated, which means that if something goes up, the other thing will also go up. If it's closer to -1, then A goes down, B will also goes down. Okay, so what you can see over here in this chart on your right is gold correlation with the major market, equity market, right? Which is things like the MSCI Japanese index, the S&P 500, the Russell 2000, the MSCI World Market, and so on, right? So as you can see, especially compared to S&P 500, which is second from the left, right? Gold is the correlation between gold and S&P 500 is almost close to 0. So what this means is essentially, right, they behave in their own different world, right? So you can imagine gold and S&P 500, they are a very different personality that do not have influence each other. So example, in the long run, S&P 500 might do something, but gold will not be influenced by it. So you can imagine if you have gold in your portfolio, when the stock market tanks, right, gold would be, because they don't have a correlation, gold would be a very good, excellent diversifier. So I would not be able to show you in how good it go as a portfolio diversifier without some of the historical data. So let's do some experiment over here, ladies and gentlemen. So imagine, right, let's look at this portfolio. On your left, right, there are 3 pie chart. Pie chart number 1 is a portfolio with 100% of US stocks. Number 2, the pie chart number 2 is a portfolio with 90% US stocks and 10% gold. And portfolio number 3 is a portfolio with 80% US stocks and 20% gold. Now let's do an experiment, right? And let's simulate based on historical data. Assumption, it starts at 1972 to December 2023, and with a starting capital of $500 and monthly contribution of $500. So if we do that, right, let's say we start with 500 and every month we invest $500 in 3 of this portfolio. How's the result like, right? So as you can see over here, the cumulative annual growth rate, which is the overall average yearly performance, right, of all 3 portfolio. The 100% stocks is 22.75%. 90% stocks and 10% gold is 22.57%. And 80% stocks and 20% gold is 22.35%. So as you can see, the difference, yes, there are some difference, but the difference are minimal. But the benefit is of having gold in your portfolio is shown in the maximum drawdown. So maximum drawdown basically measures, right, how much of I would say the drop that you need to endure during this whole investing period that we did, right, in this experiment. So the portfolio with 100% US stock experienced about 50.57% of maximum drawdown. On the other hand, the portfolio with 10% exposure to gold, right, has performed slightly experienced about 44.83% of maximum drawdown, which is about 11% better. And on the other hand, gold with 20% of exposure for portfolio number 3 experienced about 38.74% of maximum drawdown, which is about 23% better. So imagine this maximum drawdown as if like when the market drops, right, the pinch that you feel, the pain that you feel, right, in your gut, in your emotion, right? Imagine if having about 10 to 20% of gold help reduce your pain or your damage to your emotions, right, by about 11 to 23% better. Helps you feel better when the market goes down. So this is one of the very key characteristic of having gold as a part of your portfolio, right? Which is to help reduce your max drawdown while in the long run, keeping the return right about similar, although slightly smaller, right? Okay, so this basically today we have covered things like the China currency. We have covered some of the historical information about the China currency. We have also covered things like what are some of the strategies or things to consider if you want to invest or trade the FCNH futures and also FGLD futures. And also I also covered with some of the historical data to show you that gold is actually a fairly stable. It's not as stable as most people tend to think, and it's not the best hedge against inflation, right? So let's recap what we have learned today before we move on to the Q&A session. Number one, China has been faced with a sluggish economy and deflationary pressure in 2023. So as you can see, price have been dropping, and people in China, they are expecting a further because people in China, they are expecting price to fall further, so they tend to delay their spending. As such, right, they have been in a very tricky cycle, right, where people don't spend and price continues to drop just because people don't spend. So they are in a very tricky loop that needs to be addressed by the Chinese government. And when you want, as such, right, for those of you who are investors or traders in FCNH or the China market this year, consider how the Chinese government handle deflation, right? Especially look at how their inflation numbers are like, right, for the next few months, and see if they managed to push it further back to positive. And not only that, you want to see if US interest rate, how Fed deal with the US interest rate this year. Where are they going to raise interest rate again, despite the chances are small? But the key here is when are they going to cut interest rate, right? So these are some of the key things that you need to note while trading the FCNH in 2024. Now, meanwhile, we also look at gold, right? It's not the best hedge against inflation. It's not the most stable asset. Then what does it do? It is gold, based on what we have learned today, it is a very effective portfolio diversifier to help you lower your overall drawdown in the long run as a investor or trader in the market. Now, finally, if you want, after today's session, you want to gain exposure in the market, in the Chinese currency and also gold, please definitely consider checking out FCNH and FGLD. That is futures through the Bursa Malaysia derivatives or BMD. So I hope you guys find this useful, and this is my sharing about FCNH and FGLD futures. So I would like to pass the stage back to CY.
For your informative sharing about the gold futures as well as currency futures. I believe many of our audiences here have learned what are the key fundamentals to look at when trading gold as well as these currency futures. Now, it's now time for our Q&A session. If you have any questions related to Yi Xuan's sharing session, you can simply type your questions in the Q&A box. And remember to send your question to the Q&A box so that I can easily capture your question. Meanwhile, while waiting for questions to come in, for those of you, if you don't have any questions, I would like you to I would like to ask a small favor from you. I would like you to take a minute of your time to fill up this feedback form. Since we have already provided you an informative session for today, it takes you less than 1 minute to fill out this feedback form. You can find the links to the feedback form in the Q&A, in the chat box, or simply scan the QR code with your smartphone. So just take a quick minute to share your feedback. Will greatly help us in improving our future sessions so that we are able to continue to deliver valuable content that helps you enhance your learning experience. So just take 1 quick minute to complete this form, and we will begin with the Q&A soon. So I give you 1 minute to complete the feedback form. another 20 seconds to go. All right, 1 minute has passed. If you have already submitted your feedback, I appreciate that. Thank you very much. Well, for those of you who haven't finished yet, you can continue to finish it. Now let's continue with the Q&A session. So to ensure we have enough time for all questions, I will be selecting the most relevant questions from the Q&A box. I will also restructure some of your questions so that it's easily understandable for everyone. So since we have quite a lot of time right now, so we will begin with some of the questions here first. Now, Ethan, earlier you shared that gold is fundamentally volatile in nature, right? Is there any specific reasons for that?
Hey, CY, thanks for the question. When I say gold is fundamentally volatile in nature, is there any? I think to make it to structure it my sentence better is fundamentally more volatile relative if I may just quick and may I share a screen from my screen from the presentation just now?
Yeah, sure. Go ahead.
Yes. Yeah. Give me a moment. All right. Now, when I mentioned that gold is fundamentally volatile, I'm comparing it to the likes of the U.S. Treasury bond and home price. So one of the reasons why I do this comparison is because a lot of people, especially investors from a different generation, right? They tend to have the perspective that whenever they have extra money, buy gold. When they have the extra money, invest in gold because they think that gold will be stable. Okay, so but what I'm trying to show or display this comparison here is that gold they are actually far more stable asset class that in the market compared to gold, things like the US Treasury bond and so on. Okay, and on the other hand, I also want to show you how gold can be in certain times actually display volatility that is on par with the likes of the stock market, as you can see in the chart over here. You know, things like the S&P 500, when you look side by side between gold and S&P 500, the swing, right, it's actually very it can be quite similar in certain years, right? It swing up and down just like the stock market. So what I'm trying to I would say the key message that I'm trying to imply or deliver here is to show participants or all of you here today is if you ever you have the thought that gold is something that helps you as just as a specific instrument help you you buy it because it's stable. No, there are way more options that are more stable in the market. Yeah.
Okay, so relatively speaking, gold is fundamentally volatile in nature compared to some other asset classes. Is that what you mean?
Yes, exactly.
Okay, besides that, while we are on the topic of gold, right, are there any factors that typically influence the price of gold?
Gold, yes, gold is actually very unique from my own study or research. Gold is actually very unique because unlike things like unlike other asset classes in the market, gold is actually bought by the reserve is one of the major asset that banks central banks around the world they buy it, right, to store as a store of value. So as such, what will happen with gold is there are certain institutions out there that buy gold and then they will lend it to institutions which pays them interest. When this happens, right, essentially what I'm trying to say is gold is special because there are big institutions behind that help or big financial institutions transact gold, which also helps influence the price as well. So this is perhaps I could elaborate further in future sharing sessions, because I don't have like a quick explanation towards this. But yeah, but essentially what I'm trying to say is big institutions buy central banks, they buy up gold. So this caused them to have a very interesting seasonal pattern, which I could share in future sharing sessions. Yeah.
All right. So also another question related to gold. Looking at historical gold price, right? Is it correct can we say that gold is actually negative correlated to economic conditions?
This I would love to go back to my slide if you don't mind.
Yeah, sure. You can share your slide
Yeah.
out.
Yeah. So I would say definitely I think economic condition like inflation in the market, based on historical data, gold has already shown that based on it is not an ideal inflation hedge, especially when the inflation in the market is considered high, which is above 4%. So as you can see in the chart over here, right, from 1973 to 2022, when inflation in the US is above 4%, it actually swings. There's no specific pattern, I would say, that what will happen when inflation is more than 4%. It actually swings up and down, sideways. And sometimes in recent years, if you notice, right, relative to into the 80s and so on, the performance has been relatively down compared to compared to the past. So back to your question, does economic environment have any relation with gold? In the case of inflation, I don't think it is in case of high inflation, I don't think it's reliable to use gold, or at least to buy gold just to protect against economic condition like inflation.
Okay, so based on your presentation, is that gold is actually not a good hedge for inflation? Is that what you mean?
Yes, exactly.
Okay, you can maintain your slide. While speaking on
sorry.
the while we are also on the topic on gold, right? Oftentimes I hear about, investors may have a little bit misconception about buying gold to hedge inflation. In fact, is it what kind of gold that should we actually use to hedge against inflation or uncertainty? Is it physical gold or gold futures, in fact?
Oh yeah, this is actually a very good question. Maybe I should perhaps goes back to some give me a moment if you don't mind. I should goes back to my earlier slide. All right. I would say personally, I would think having exposure to go through gold futures is actually pretty good, because first of all, it gives you the flexibility to protect yourself, be it on the long or short side. Because when it comes to the physical gold, the only way you can make money from that is through gold price going up. But through the gold futures market, you can actually based on the market condition, you can go long or short. So when the gold price goes down, you can hedge against downward price movement of gold by shorting the gold futures, or when you are bullish towards gold, when there's a condition is bullish in the gold market, you can go long. So this is one of the good things as well. And not only that, if you own gold itself, right, as a physical gold investor, you can also protect yourself through protect your own downside through gold futures. Because if you own gold, especially physical gold, right, when the market is bearish towards gold, you can actually you can imagine, right, price of gold drop means the value of your physical gold drop, right? But you can protect against that by going to the gold futures by like the FGLD to short the FGLD market. So you make money while shorting in the futures market, but at the same time, the market may be bearish and your physical gold loses value. So plus minus, you protect yourself against the go against your investment losing in value. And I would say another great thing about FGLD futures is because it's a futures market, by default you already have a leverage or as a nature of futures. So in short, right, you only need you need a lower your capital requirement to trade the FGLD. It's actually quite low that I think most Malaysians can afford. Yeah.
Okay, so it seems like FGLD, we don't just only able to buy or take a long position in gold. We can also actually take advantage in, if let's say gold price comes down by shorting FGLD. Now, there's also another question. I think it's quite quite similar to goals, right? Earlier on in the currency futures, when you shared about inflation as well as interest rate, right? Will these two factors influence gold price as well?
Currency, sorry, your question is inflation and
will inflation and interest rate affect gold prices?
I see. Interesting question. I think I would say not directly, because by default interest rate causes inflation to fluctuate up and down, right? So if that's the case, then by default we have already shown that gold is not the best. It performs rather inconsistently with inflation. So since interest rate will influence inflation, then and since performance of gold do not perform consistently with high inflation condition, then I would say from this is not the most I don't think the impact would be consistent. Yeah.
All right. There's a question that is related to these currency futures, the Chinese currency. What are the fundamental factors that we need to actually look out for when trading FCNH?
Yes, the fundamental factors. This is a good question. I think there are two fundamental factors, especially this year, right? This is a topic that is very interesting right now in the global market. Number one is you would like to see if the Chinese government can deal with the deflationary condition in the market right now, because in January the inflation figure is negative 0.8%. So this means that they are in a deflationary environment right now, right? So you would like to see, right, especially for the next few months, which is very critical, that whether the Chinese government or the authority can push inflation back up to the positive environment, which means that instead of the current deflationary environment where price drop, you want to see price increases back in China, because when price increases back in China, it also means that behind the scene, what's happened is people start to consume. People start to not delay their consumption anymore. People start to spend. So you would like to see that in the market. And also, when you are trading FCNH, you also want to see how the US, especially the US, decide on their interest rate. Their decision on their interest rate this year. When are they going to cut? If US going to cut interest rate, then relatively speaking, the Chinese currency will going to strengthen. So as a trader or investor of the Chinese currency, you would like to have the foresight, right? The current, I would say, forecast of most people is that the US would likely going to cut their interest rate, but the timing, I think, is something that most traders need to be more. I would say something that need to catch it nicely, I would say. So yeah, if a trader can foresee that the US is going to cut rates soon, right? Then taking a shot in the FCNH because FCNH is USD CNH, right? So this means that if US is going to cut rates, means this also means that the US dollar is going to weaken against the Chinese currency. So if there is such foresight, then shorting it ahead of this could be a good idea, or you can short once the trend is already formed. So it depends on the type of trading style that you are doing as a trader or investor.
Okay, so let me clarify a little bit. So it means when US cut interest rate, then it means US dollar would be weakening. Is that correct?
Yes.
Okay, and how about for inflation rate? When let's say the Chinese increase inflation rate, what would the impact for the Chinese currency? Would that be strengthening or weakening of Chinese yuan?
Okay, if the one of the way China can improve the whole situation with the inflation thing is okay, actually okay, I would say from my own understanding, China is in a very tricky condition right now because the only one of the major tool that they can have in their disposal of decision making of their policy is to increase or cut interest rate, right? Okay, so when China can increase their interest rate in order to induce inflation, hopefully induce inflation in the market, right? But as what this would do as a result is because the China economy fundamental is already weak. So you can imagine, right? The whole house with like 3 or 4 pillars, 1 or 2 pillars are shaking already. So if you add more weight, right, which in this sense is to increase interest rate in the China economy, right? It will make the already fragile China economy to potentially crumble because they haven't solved the real estate issue, right? That's one. They haven't been able to effectively deal with the drop in export and also the weak retail sales numbers. So with that in mind, right, we can effectively say that China cannot play. There are only one side that China can play with their interest rate policy, which is to further cut their interest rate because they cannot raise. When you raise, you face a risk of making the economy even worse. So as a result, right, China is, I would say, again, this is my own opinion and understanding after researching about the China economy is they can only cut interest rate, which is to weaken the currency further. So as a result, this would but not only that, right? It's not only tricky because China is not only dependent on their own policy, they're also dependent on US interest rate decision, which makes the whole things even more tricky because they don't, technically speaking, have the control towards that. So yeah, this is something that the China when you invest or trade the FCNH, you need to be aware of as an investor or trader. Yeah.
Okay, so it seems like there is a quite complex situation to to really understand the economic the structure as well as functions to see which currency strengthening or weakening. All right. Yixuan, just now earlier on you shared about the portfolio combination when we add the gold futures into it, right? Can you put that slide up because there is one participant asking about what is actually the meaning of standard deviation when combining with gold into the portfolio?
Yes, give me a moment. Let me just very quickly. Let me quickly get the slide up. Okay, so to answer, that's actually a good question. So basically, right, for those of you who are watching who are not aware where's the standard deviation, if you look at the blue color circle, CAGR, which is cumulative annual growth rate, the one on the right is what we call the standard deviation. So basically, for the audience that asks what standard deviation means, is basically you can imagine how much of the fluctuation are there. So basically, standard deviation, right? When you look at the market, it tends to show you the lower the figure, essentially, the most I would say stable it is relative to what it tends to fluctuate in a more, I would say, composed manner. So imagine the higher standard deviation means the market tend to swing up and down a lot. But on the other hand, a lower standard deviation figure means that it tend to be more composed. The movement tend to be more steady, right? If I can find a better word, but steady is, I think, the word that I would use right now. It would be more steady in terms of market movement, the swings up and down. So you can imagine the figure over here, right? 15.44% for stocks, the portfolio with 100% stocks, right? Close to 14% for US stocks, 90% US stock and 10% gold, and also close to 13% for 80% US stock and 20% gold portfolio. So you can imagine, right, with a portfolio with 20% of gold exposure, you tend to experience a smaller swing in the market, which translates to a lower standard deviation. So this is what some of the reference that you can use when you are looking at all these numbers. Yeah.
Right. So earlier on, when you shared that the gold futures is not so good in hedging inflation, so it seems like gold futures can hedge against economic uncertainty. Is that what you are referring to?
I think I would not be because I don't have the best data, right? For other, I would say, economic uncertainty. So I don't have I wouldn't be able to comment on that. Yeah.
Okay, so on top of that, well, generally when people mention about economic uncertainty, right, will it actually reflect in, let's say, in stocks portfolio?
Yes, definitely. I think that's one of the reason why. Let me, if you don't mind, let me just reshare what I showed just now, which is very interesting. Yeah, so as you it's definitely helps when you when there's economic uncertainty, the stock market will definitely show with all the, as you can see in the green color circle, right? It definitely shows in the drawdown in the market. So this also comes back to a point where gold is actually a very, I would say, based on historical data from what we can see over here, is gold actually helps tone down all the imagine having like imagine having like a portfolio, part of a asset class that help you tone down the fluctuation in the market. So when there's economic uncertainty in the long run, it actually helps you in terms of reduce the drawdown that you experience as an investor or trader in the market.
Okay, so it seems like adding gold futures into the portfolio does really lower down the overall standard deviation,
Yes,
overall
right.
fluctuation in the portfolio. Okay, so it seems like gold futures, there is a benefit in adding gold futures in our portfolio, right?
Yes.
Great. Now, there's another question. Earlier, when you shared about the Chinese currency, right? Can you elaborate a little bit further on, the first fundamental factor of the Chinese yuan? Because as you shared about the opposite decisions versus the US market.
Yes, for sure. Perhaps I could go back to the slides. Yes. So this is actually a very interesting scene in the market, because in the past, right, before China actually goes up, become a global power in the market, right? Basically, a lot of decision making with the rates, US rates, other countries tends to need to follow, right? But in this case, it actually shows that not all countries have to follow what the US have to do. So so in this is one of the reasons why that there's such a big discrepancy between the China market and the US market, especially with their rates decision. So what happened with in this case is China actually have to now that we have a bigger clearer picture of the fundamentals, right? China have problem with their property market. China is experiencing lower export. China is experiencing slower growth in their retail sales, right? They have to cut their rates, right? Why do they cut rates? When they cut rates, right, they hope, right? Their hope is that they can induce liquidity in the market where people borrow money, right? They can spend more, right? And people can spend more, and also it helps spur the economy. But apparently that's not the case in the market right now, right? Because like I described, people tend to they are in a deflationary environment, so people tend to expect price to drop further. So as example, if I want to buy a house which is 500,000 in value, right? This month it dropped by $10,000 dollars or ringgit or whatever in currency form, right? And next month, because we are in a deflationary environment, I expect it to drop further. So why would I want to buy right now? Because when I know that I can buy for a cheaper price next month or the coming month or so. So this caused China to be in a very tricky environment despite having cutting rates for in 2023. So not only that, this is also a very tricky environment for China because of their relatively less attractive rates, right? Capital are flowing to the US market, at least for right now, when the interest rate in the US is higher, is high. So as a result, right, capital outflow and economic fundamental weakness in economic fundamental, it caused China to be in a very, I would say, awkward position in their economy situation, and hence you can see China is really doing despite having a very few tools to play with, right? They are really trying their best to spur growth in the market. Yeah.
All right. Besides that, can you just now I see on the third factor of CNY, right? Can you elaborate a little bit more on that?
Yes. This is also a very interesting, I would say, interesting situation because not only that China is not only facing challenges domestically, because last year what happened was global demand started to be affected, right? People overall, not just China, Malaysia export dropped as well last year. So as a result, China's export has actually dropped for the first time since 2016. So as you can see in the figure here, this in the most right represents 2023, which is the year last year where export actually is in negative territory for the year. So this, as you can see, when compared to 2022 and even pre-COVID years, it actually dropped. So what you can imagine from this is you can imagine that what support the whole export industry, the manufacturing industry, and so on, right? So you can imagine the manufacturing industry has been dropping as well. So I didn't show here, but unemployment has been an issue in China as well. That especially for youth unemployment, that China has decided not to publish the data. I forgot which month, but they have decided not to publish the data for youth unemployment. So this is something that is spreading in China since last year. So this is definitely shows weakness in the China economy. Yeah.
Okay, so it seems like, when trading the Chinese currency, besides inflation and besides interest rate, looking at the export data and consumption, it's pretty important as well.
Yes, exactly.
Okay. Now, one more final question for you. What are the advantages for of trading gold futures as well as FCNH?
Yeah, for sure. In my opinion, let me just quickly go back to the slides. I think the benefits of trading FCNH is actually massive because again, for everyone who's watching, FCNH is the latest and actually the first currency futures listed on Bursa Malaysia Derivative. So it actually provide, unlike other currency market, the foreign exchange market that people unlike the other currency market, right? The futures market is actually regulated. So it means that if you want to, it actually give you a regulated and protected environment to actually have exposure to the currency market. So if you are bullish towards the US dollar, you can long the FCNH. If you are bearish towards the US dollar, you can short the FCNH. So this is so it allows you to imagine you can perform your trade thesis on not just the US dollar and also the Chinese currency. So you can do exposure or express your trading thesis on two things at the same time. So this is something very interesting as well. And especially for businesses, if you own businesses and in US dollar or the Chinese currency, you can also use FCNH to hedge your against a downside risk of certain currency weakening. Like if you think Chinese currency is going to weaken further, you can use FCNH to protect yourself against the currency weakening. So that's one of the good thing as well. So yeah, I would say for not just for retail traders, if you are a bigger player, right? We are business person or bigger player in the market with US dollar exposure and also or Chinese currency exposure. I think this is a great product to consider. Now, for gold, I would say again, because it's in the futures market, in Bursa Malaysia Derivative is regulated, and it's you can rest assured that it's one of the best, I would say, as instrument to get exposure to gold. Yeah. So yeah.
All right. Thank you very much, Yishen, for answering a lot of questions from our audiences here. Now, allow me to conclude today's webinar session. Now, once again, let me promote our upcoming webinars, especially for those of you who missed out this announcement earlier, as this is a LLF Let's Learn Futures webinar series. It's a series of topics where we will be conducting every Tuesday evening, same time from 8:30 p.m. until 10 p.m. There are lots of content-packed and informative topics where you will be learning some practical knowledge about futures trading from our experienced speakers. So if you'd like to join any session, you can scan this QR code and register the topics that you would like to attend. Once you scan the QR code, you will come to this page and there will be an event calendar. So if you would like to join the upcoming sessions, you can find the LLF webinar topics on Tuesday column. You can click on it and register yourself accordingly. Besides that, we also have the LLF online workshop. Now, this online workshop is different from the webinar series because this is specially designed for those of you who are still relatively new in futures market. So if you are interested about the futures market and would like to learn futures trading in detail, then this online workshop is definitely right for you. You can pick up your phone, take a picture, or even screenshot this page and register yourself right after this webinar ends. You can share this event with your friends and family who like to learn about futures trading. Because in this online workshop, we will be guiding you step by step how to kickstart to trade your first futures contract. Because as you see, trading the FCNH, FGLD, and maybe even other futures contract in Malaysia, it is important for you to equip yourself with the necessary knowledge as well as skills before you do it yourself in the futures contract. Okay, so education is very important because in this online workshop, every session will be limited to the first 50 online attendees. So remember to register yourself in both workshops and book yourself a seat. Once you scan the QR code, same thing, you will come to this page and there will be an event calendar. You can find the online workshop on the Saturday column. There's a website in Bursa, Malaysia called Bursa Marketplace where you can find a derivatives trading simulator. So here you can do paper trading and familiarize yourself how to use a futures trading platform before you actually raise your own money. So you can register yourself for a risk-free trading experience. So give it a try, test it out so that you can learn and begin to develop interest in futures trading. Last but not least, before we end this webinar session, let me introduce you to this Bursa Academy. This Bursa Academy is a comprehensive one-stop e-learning platform where you can get all the information and knowledge about stocks, futures, and any other products you can trade in Bursa Malaysia. You can scan this QR code on your right here, or you can Google search Bursa Academy and make sure you are able to find this correct link and you can access to Bursa Academy for more information. Alright, this comes to the end of our webinar session for today. Thank you, Yishan, for sharing an informative session with us. And to all of you who joined with us today, thank you for your participation. We hope you found this webinar both informative and valuable. And I believe you have learned a lot of informative knowledge about the FCNH currency futures and the gold futures, how it works and what are the fundamental factors that affect them. So with that, I'm CY signing off for now and enjoy the rest of your day. Good night and goodbye. See you next time. Bye.